Hi, everyone. This is Rico Figliolini, host of UrbanEbb, small little podcast just north of Atlanta in the city of Peachtree Corners, a smart city, no doubt. And we have smart people here today, so this is going to be a great conversation. Can't wait to have it because even I don't know everything. So thank you, guys. I appreciate you joining me. Phil Adra and Victor Borowsky, got it, and with Four Corner Capital. Let's get that right. So I was looking through some stuff ahead of time because I have to educate myself before I do these things. And I love the way you guys phrase some of this stuff because it just, for me, I don't think about this stuff, and I should. I'm 67, so I really should think about this stuff. So same for you all, I bet. So why don't we, before we even get to that, tell us so then people can know a little bit more about you guys personally, right? So where do you guys come from? Let's start with you. Phil.
Sure. So born and raised in South Louisiana, New Orleans. I moved to Atlanta 20 years ago, and I have lived and or worked in the Peachtree Corners area since 2013. So I've been here 13 years. Huh? Put down roots. My office is here. My family's here. My in-laws are here. So our church, our country club, our kids' sports, it's really our community for the last decade and a half.
Excellent. What about you, Victor?
So I was born in Detroit, but moved down here when I was very young, just a few weeks old. So I basically call myself
a native.
A native, right? Basically, as a native about anyone my generation was. Right. But grew up in Dunwoody. Went to Wesleyan when it was still over in Sandy Springs, in the old location, before it became part of the Peachtree Corners community. And graduated Georgia Tech and stayed in Atlanta. I've been in Atlanta my whole life. So shortly after my wife and I got married, we got married back in 2004. Lived in Brookhaven at the time, but we're up in Peachtree Corners within a year in Neely Farm.
Wow.
And I've been in the area basically ever since, Peachtree Corners, Dunwoody, Johns Creek area.
So you're we'll call it homegrown to some degree. Right?
Homegrown.
Yes. I come from New York, so it's a little different maybe. It's a little older when I came.
I would never have guessed by your accent.
You think? So you guys live, work, worship, invest your money here. Your office is on Peachtree Corners. In fact, when I drove by here, I was like, wait, they're in the Intuitive campus, which is kind of cool to be here. Brand new offices, great place to be.
A lot of construction here. Last 3 years.
Yes, for sure. It's almost
but
over.
It's exciting. I think it was like the largest land deal, or one of the largest land deals in Gwinnett County history. And so watching all these buildings and parking garages go up has been interesting. We've been on the same floor for the last decade, so it's all happening around us.
Oh, wow. I didn't realize that.
Yeah.
So this building was here before everything started.
It was one of the few that were still here.
As little as I know, this looks like a new building practically. I guess it must be because of what's around it.
Sure.
Yeah. So why don't you talk also a little bit, because you've made your community in North Gwinnett here, Peachtree Corners, Duluth, and all that. Talk a little bit about the local initiatives, what you guys participate in, the organizations you're involved in. I think people would like to know that, because you're not just business people. You don't just live here and go somewhere. You're involved in the community. You're invested in it, if you will.
Absolutely.
Well, first, a big part of our lives are in this community. We obviously have an office right here. Two of my kids are at Wesleyan. He's got kids at Cornerstone. We spend a lot of our time and a lot of our money in the community. I kind of brag about the fact, I know this was important to him as well, that our lives are all the vast majority of our lives occur within about 5 miles of this office. Really, probably mostly within about 3 miles.
Oh, wow.
So whether that's our club, our church, our office, a lot of the restaurants we go to, our homes, all of it is kind of right here in the community. In terms of community involvement and so forth, my wife and I are both on the board of Young Life in Johns Creek, which focuses on a lot of the local schools.
Sure.
I don't know how much you know about Young Life.
My kids were part of it when they were younger. I think elementary, middle school, somewhere around there.
Yeah, it starts in middle school with wildlife. Yeah. And it's been an organization we've been passionate about. Our kids have really enjoyed. over the years, and it's had a meaningful impact on my two older girls. My youngest is just finished 5th grade, so she's not quite there yet.
Okay.
There soon.
Neat. Phil?
Yeah, to echo what Victor said, the things I would add on to that would be, we're sponsoring, for example, we're the lead sponsor of the Color Run coming up in August, right here in Peachtree Corners.
Yep.
We're really interested in community events.
Right.
We see a lot of our friends and clients and family members at these events, so we want to be a part of that. We want to help the city with those types of things. I would add, I just lost it.
Yeah, we volunteer at the Norcross Co-op.
Oh yeah, I was going to say the Greater
through
Perimeter
church.
Chamber,
Yeah,
the Peachtree
okay.
Corners Chamber. That's
Peachtree
what I was
Corners
looking for.
Business
So a lot of the
Association.
business associations,
Right.
once we went live on our new entity 6 months ago, we really wanted to make that a focus of really investing heavily into those organizations
cool.
and getting plugged in.
That's
So,
great. There's
yeah.
there's a lot of that. A lot of organizations you guys are involved in.
Yeah.
That's cool. You guys have big families too, apparently.
I got 3 girls.
I've got 4 kids,
got
3
4
boys
kids.
and a girl. So
And,
yeah, it's a table for 11 when the Adras
Yes.
and Borowskis go to dinner.
Economic impact.
We're doing our part, Rico.
There
We're
you
doing
go.
our part.
I could see that. That's good. So let's get into a little bit about Four Corner Capital and what you guys started 6 months ago, right? Financial planner, money manager. I'm not a money manager, I'm a financial planner. My checkbook, my wife's checkbook, we all have our things to do. But
Sure.
explain to us a little bit about what your company does. What's the difference between those two things also?
So the genesis for this was the thought that there's really 4 things you can do with money. You can protect it, you can grow it, you can distribute it as income, and you can transfer it at death. And most people in our industry really just focus on the grow piece of that, right? And that's what we would define as money management.
Okay.
I'm going to manage assets, I'm going to help you build wealth, I'm going to help you grow it. And there's nothing wrong with that. It's a very important part of financial security and financial planning, but it's just a part of it. And so if we ignore the protect and distribute and transfer pieces, we're not really viewing that as a holistic financial plan.
Right.
And so our firm, Four Corners Capital, focuses on all 4 of those areas: planning, investments, retirement, and legacy. So we're helping clients protect, grow, distribute, and transfer wealth. That's how we define comprehensive financial planning.
Sure.
And there really is a difference between a financial plan versus just an investment strategy, if that makes sense.
Yes.
Yeah, I think, to that point, I think one of the massive issues with most people's financial plans, because whether you have a financial plan or not, you have a financial plan. It might not be a very intentional one, but whatever it is you're doing, it's a plan.
Right.
And I think people get so focused on how do I build wealth during my accumulation years. And there are a lot of ways that we help our clients in that area. Don't get me wrong, I don't want to downplay that at all. But the distribution phase, as we kind of transfer from this, or downshift from this accumulation phase to the distribution phase, I would tell you far more people get it wrong there than get it wrong on the building and growing side of things.
How do you, when you approach people, or when people come to you, and you start explaining this, I can see some people getting overwhelmed by it, right? How do you explain it in a way they can understand where, especially that second half, if you will, of distribution?
Well, before I even go into that, I think
Yeah.
it's important in general to give examples, right? Like
Wow.
real world examples of the impact that things can have. And, whether it's, around distribution, if it's around how to structure assets, the importance of asset placement, or how much you need to save, or tax impact, bringing it kind of to life. And I'll give you on that last one that I just said, tax impact. I'll give you a quick example. One of the areas of focus in the work that we do is around helping our clients grow wealth efficiently, right? And there are a number of areas that we focus on efficiency with respect to, but one of the key areas is around tax impact. And just, again, to keep it simple for you, if you took $1, right, and you invested $1 in some type of investment that doubled every year, right? Obviously, there is no such thing.
No,
right?
no, absolutely.
Not legal, at least. We like to keep things legal here.
Yes.
But if it did, that dollar would grow the next year to 2, then the next year to 4, then to 8,
Right.
then 16, 32, 64, so on and so forth. After 20 years, you'd have $1,048,000 in change. If you take the same dollar, you double it every year for 20 years, but now you tax it. Okay? Just at average American's basically top tax bracket, right? And you throw some state tax on there. Maybe you end up with about 28% total tax,
Right.
Between state and federal. Instead of doubling, you're growing at 72% per year, right? 100% growth again yields $1,048,000 after 20 years. 72%. Right? What would you guess? We're going to bring you back into this. Rico, what do you think 72% gives you?
I
at the same
can't even
time?
guess at that. It's probably 700,000. I don't know.
Be kind of logical.
Yeah.
It's about $51,300.
Really?
You lose over 95% of what you have, or what you would have had, just because you were paying tax along the way. So trying to kind of bring things to life, I think, is very important. Examples can do that.
I like the examples. So let me give you another example then. Because there's a lot of businesses out there, right? Business owners and stuff. You're a business owner. Your cash flow's reasonably good. You own some property maybe. Your kids are almost out of school, but you've saved money, but you're also working through the way a lot of small businesses are. They work through the cash flow, right? I mean, that's the way that works.
Sure.
At some point, you start thinking, need to do something here. Got life insurance, got a couple of properties. I got maybe a retirement plan. Maybe the business is the retirement plan, which in a lot of small business, I've a lot of friends I know, that is the retirement plan.
Exactly.
They hope to exit at some point, if God willing. So how do you talk to those people about that? Because that's a lot different than, let's say, I'm on TikTok a lot and Instagram and stuff because that's what we do, right? And there's examples where, yes, you should have $5 million in liquid cash to retire. Otherwise, you won't make it. It's just like, no one has $5 million in cash unless you're making, I don't know, $500,000 a year for 40 years. Maybe there you don't even have that. But so how would you know
you hit
that?
the nail on the head. For most small business owners in particular, their financial plan is the business, right? And that's the best ROI. There's no strategy Victor and I can put together that would at least convince them that it's better than what they're doing, that they've poured their entire life into. And so the starting point with that conversation would be understanding that first, that is their financial plan, understanding the valuation, what is the exit, what is the succession strategy, how do we monetize this, can we monetize this? Even if it looks really, really good, we'll call that the A plan. We would try to run or put together a customized B plan. That's what I call it for business owners. Let us be the B plan.
Okay.
If we try to tell the business owner that we're going to be the A plan, they're going to stiff arm that, right? Because that's their baby.
Yeah.
And that is a very,
Makes
very
sense.
viable financial asset.
Sure.
So that's their A plan. We would typically try to come alongside and build a B plan, diversify, create more liquidity, create some tax efficiency parallel to the business. Part of that is obviously de-risking the entire
Right.
financial picture.
Sure.
If it doesn't go exactly according to plan, right?
God knows, yes.
But one thing you said, just to add on to this comment, is most people, when we meet them, are doing a pretty good job. Most of the clientele we serve are pretty successful, and they've checked a lot of boxes. You mentioned life insurance. You've got 529s for the kids, maybe a 401k at work, a business. They've checked a lot of boxes. It looks pretty good. No one, for most of the people we initially meet, no one has come alongside them and simplified and coordinated all of those different pieces and brought them into a cohesive strategy, a cohesive plan.
Right.
And that's really first and foremost what I help them understand. That's the seat we can sit at the table with them, is putting all of those things together, identifying the gaps, and then optimizing from there.
And when you're talking like that, or because some people think you have to have different professionals involved with you, right? Lawyer, accountant, and all that. Because do I do a trust fund? Do I include, if your business is an LLC, should it become a C Corp in a trust? And all that, because if you sell the business, there's tax consequences. I don't know. I know enough to keep me dangerous, but I don't know enough, right? And there's all that, because most people think, they're listening to all these things, and they don't know. I mean, do you address all those things as well?
We do, and let's be very clear. In most of our client relationships, we're really the financial quarterback.
Okay.
Right? Now, the quarterback. I know you watch football at some point in your life.
A little bit. Yeah.
The quarterback is not playing every position on the field.
No.
Right. The quarterback may know how, and they know how to engage the other players on the field, but at the end of the day, they are not playing every position on the field. So we're not attorneys. We don't draw up estate planning documents, right? Or business succession plans and so forth. We don't do buy-sell agreements, but we consult with our clients on these topics. We don't file tax returns for our clients here, but a lot of the issues in a huge area of focus with our clients is around tax efficiency. So that's what I would tell. I'd tell you we act more as our client's financial quarterback to help them understand where they need to engage the other professionals, and then we engage with those other professionals.
Well, and that's what I guess that's where I was going with that. That your firm can plan that, but like a general contractor, let's do another analogy. You get the contractors in to build a house, if you will. You know what has to be done: the walls, the floors, the cabinets, all that. Get the right people in to do it. But you're the one that's planning that out as far as what has to be done to protect, to distribute, and all that.
That's right.
Right?
Exactly.
Okay.
Yeah, there's a lot of the protect, grow, distribute, transfer that we can execute on. There are certain pieces, as Victor alluded to, with estate planning documents and things like that, where we need to coordinate that with other professionals. And we have spent decades developing those relationships. It's part of why we're involved in some of these organizations. We want to put the best and brightest around our clients, because we're just one seat of their financial team.
Right.
We may be coordinating the entire thing, but we really play one specific role or two or three specific roles.
Okay.
Anything that goes outside of what we can execute on, we need other professionals to help.
Sure. And you're working with professionals already that you can refer and stuff that you already have a relationship with and all that.
That's exactly right.
So as far as returning a pile of savings, so people have savings, right? How do you keep that stream going, though? Someone retires at 67 or wherever they retire, or semi-retired, because most business people don't quite retire, maybe. You want to keep that stream going. You've already saved all that. How do you do that? How do you protect it and then continue that stream going? Because like I said before, there's some people say you need $5 million liquid to live the rest of your life. Depends on what level you want to be living.
Right.
Yes, we want to be comfortable, but how do you protect that? How do you make that stream continue?
So first, $5 million liquid, like you said, that obviously completely depends on what someone's lifestyle is going to be and what they want.
Right.
Then you also mentioned earlier, a business owner saying, my business is my retirement plan. Well, the business is really the plan to grow enough wealth to retire. Right?
Right.
It's not the retirement plan. What do you do once you do sell the business?
Yeah.
So if you sell the business for $5 million and you've got this $5 million liquid, what
Right.
do we do to ensure that you have the greatest likelihood of achieving your long-term goals? Obviously, it starts by really understanding what our clients' long-term goals and objectives are, and those vary dramatically by individual. Once we have a clear understanding of that, we help them develop a strategy for the distribution of that wealth over time. And like Phil said, as we're talking through distribution, obviously legacy and transfer is a consideration.
Right.
So what do our clients want to leave to the next generation? What kind of financial legacy do
Right.
they want to leave behind? So planning has to be done that mitigates the risk of volatility, right? Volatility in retirement is a very different thing than volatility in your accumulation years.
Right.
Right.
You don't mind it going up and down over 20 or 30 years, but when you retire, you don't want that going up and down.
That's right.
Of your
we
investments.
don't mind
right?
it when you're
Yeah.
accumulating. Well, you shouldn't really mind it when you're accumulating. Well, nobody likes to see their account go down.
Sure.
But you're investing at lower prices, right? I mean, it's like the whole dollar cost averaging concept. You're putting more money in as things go down. And so you're buying more shares that will eventually be worth more as long as you believe the country's not going to collapse.
Correct.
In which case,
Correct.
none of your financial planning would matter anyway.
Just be careful with SpaceX and index funds. Okay. Yes. Go ahead.
That's the next episode.
Yes.
But no, listen, that risk is key though in your retirement years because you're no longer adding money. You're now withdrawing money. So if all we do is invest that $5 million or whatever the number is for a client, what happens when the market's down? And you still need income to live off of.
Right.
Are we going to just sell at a loss and sell at a further loss when it continues to be down? Right? That is selling at a loss is a great way to earn a horrendous return on your investment portfolio. Right?
Yeah.
So we have to employ strategies that mitigate that risk. And what it ultimately ends up being, Rico, it's a diversified structure. We've got multiple income sources, different types of vehicles. We have a piece that we often show our clients that almost shows kind of funnels, right? And the ability to turn the spigot on and off from these different buckets of wealth that we diversify into for our clients based on all of the market circumstances. So for our clients that are retired today, every year, every fall, we're developing an income strategy for them for the next year, right?
So it's not just set and go. It's like you have to revisit because things do change. Right. So you're constantly
Of course,
adjusting.
Yes. Ongoing review, monitoring,
Yeah.
and adjusting.
Yeah.
Because a client can say they're going to spend $100,000 a year, and then after year one, they had a little bit too much fun.
Yeah,
right? And so we've
yes.
got to bring it back to actuals and understand their goals and the different variables. What did the market do? Has their health changed?
Right. That's
Because
it.
you have what makes distribution challenging, as Victor's alluding to, is the variability of the stock market and other, sort of volatile assets, and the variability of life expectancy.
That too.
Are you going to drop dead at 72? You're going to live to 96. How do you plan around these two variables?
Yeah.
That's why accumulation, we say, is much simpler. It's much easier than distribution. How do we unwind
Yes.
tax efficiently and income for life? And there's an unknown period there.
Yeah. You could go 20 years or 15 years or 30 years. And if you're not putting out the right amount of money on that, like, $100,000 a year,
Yes,
at
and
the
you-
end of that.
And you never know. I mean, to me, it's kind of like the question you bring up, I just get it started and like kind of set it and forget it. That's almost like hopping on 141 out here and putting it on cruise control. And as the speed limit keeps changing, you just keep going the same speed.
Yes,
right?
that's not a good idea.
I've got adaptive cruise control now, Victor. Do you know about this? You're probably hasn't.
No, I'm
So as the car slows down, you don't hit the car. It actually slows it down and keeps it 3 cars.
I'm just talking about the speed limit changing.
Forget about that. You got to worry about the caravan of cars that are going in and out of your lane.
Yeah, no,
In
exactly.
Atlanta? Yes.
Yes.
So
Yes.
you think about things like tax rates changing and
That
tax
too.
brackets
Yeah.
changing, whether it's income tax brackets, capital gains brackets, or the IRMA limits. The IRMA being the income that's considered for towards what you have to pay in your Medicare Part B
Yeah.
premiums,
Yeah.
right? So there are a number of things like that where we're playing this like tax bracket game for our clients in retirement to
Plus-
ensure that we're mitigating the impact of tax.
Plus, legislation, I mean, your representative loves to pass legislation. So one year maybe there's no tax benefit. Next year, there is a tax benefit. It could be on anything,
Yes.
right? Boats, lake house, whatever. You might be okay set today, but 2 years from now, all of a sudden that tax benefit's gone. Does that affect?
Absolutely it does. Different deductions phase out at certain income levels. Even things like here in Metro Atlanta, different counties have different requirements for
Right.
being able to opt out of the local school taxes.
Yeah, homestead
right?
exemption and all that. Sure.
Yeah, and I mean, the school taxes for seniors can be a big thing to be able to
Yeah.
opt out of that. But if a county has an income limit on it,
Right.
Yep.
that's one of many
That's
considerations.
funny. I was looking at that. Gwinnett County is actually pretty liberal, pretty good, but DeKalb, I think, and Fulton are not.
Not as friendly.
Yes.
Yeah.
So it depends where you live. Life insurance. How do you handle that? That was something else I think that was considered a possible asset versus just something that's there.
So it's typically a risk management tool first and foremost, right? And back to the protect, grow, distribute, transfer methodology, life insurance is going to fit in that protect space, making sure clients are building their financial plan on concrete, not on sand.
Right.
Emergency cash, health insurance, life insurance, disability insurance. So it's going to fit in as a risk management tool, right?
Okay.
There are types of life insurance that serve as safe money or cash alternatives,
Right.
and that can be part of, for some clients, part of that. What happens if the stock market drops 30 or 40 or 50% when I'm retired?
Right.
Well, we need non-volatile assets to be able to draw down to weather those storms. And so that's sometimes where life insurance can fit into a retirement income distribution plan. Most people think of it as a death benefit at death. That is its
Right.
first primary use. But there are aspects of certain type of life insurance policies that can be used for retirees to draw down income in a volatile environment.
People also have property assets, right? Sometimes they're mortgaged. Sometimes by the time they retire, maybe if they're fortunate, it's completely paid off. Of course, you hear all sorts of things about like all well-to-do people where they don't have an income, they borrow against their assets. That becomes a non-taxable thing. You have to really have a lot of that investment to be able to do that. But does that ever come into play as well?
Absolutely.
It's a good question. What you're talking
Yeah.
about is securities-based lines
Yes.
of credit, right? And securities-based lines of credit are not just for the ultra-wealthy. Right? They can work very well for anyone. If you think about it, a lot of people maintain an emergency reserve, a cash reserve account, and that is obviously highly advisable because you don't want to have to draw from your investments anytime something comes up, right? Some short-term need. You need to replace the HVAC in your house. You got to sell your investments to do it. You got a damage to your car. You need new brakes or something. You got to sell your investments to do it. That's not a good strategy. All right, so you need to have some liquidity, right? An emergency reserve. One way that people can accomplish that emergency reserve is to have a securities-backed line of credit. This is something that is no cost to you unless you're borrowing from it, right? Kind of like a
Right.
home equity loan.
Right.
And so if you're not borrowing against it, it's costing nothing. When you do borrow against it, you pay something. If you think about it, if someone's got a lot of cash sitting around all the time for years, right, as an emergency reserve, that is money that's earning little to no return. And to the extent that it's earning anything in a money market or savings account, that's completely taxable to them as income every year. They get a 1099
Yeah.
saying,
Yeah.
you're on this piddly interest, now you're going to have to pay income tax at your top marginal tax bracket effectively.
Right.
Out of it. So, it's not a very efficient way to grow wealth. Well, over decades, that money not sitting there, if it's instead invested, right, earning return for decades, and maybe periodically, 3 months out of every 12 or 18 months or something, you're borrowing against it for some short-term need, and you're paying a little bit of interest over those few months, the additional return you could earn by having your money invested
Offsets that.
is potentially huge. Again, it's not the right answer for everyone, But for someone who's, particularly people who have a good amount of wealth built up, not the ultra, I'm not talking Elon here, but
That was the perfect example.
I know,
But he did buy Twitter by borrowing against his Tesla stock.
Yes, he did.
That's exactly what we're describing here.
I mean, and there is some grief for that. The fact that some of the ultra wealthy can literally go through life and just borrow against these and never liquidate investment because you don't have to sell and realize any capital gains.
Yeah.
Right. So it's
But yes, this is a big part of what we do with clients, because what you're discussing is like access to capital.
That's right.
What's the most efficient way? I want to buy a business for $100,000 or I need to buy a car or whatever. What's the most efficient way to access capital? Is it directly out of the account? Is it using a secured line of credit? So those are big parts of conversations, and it goes back to holistic financial planning, comprehensive planning, going beyond portfolio management, right?
So for those people who have, not to break the thought here, but for those people that have CPA, let's say, I have a CPA. What do I need you guys for? CPA, I've met lots of CPAs, and they're good. That's a great profession, right?
absolutely.
There's a place for that. But I found that some of them can't do the financial planning, can't do the work that you all do. How do you work with someone that has a CPA? How do you adjust for that?
Yeah, so I actually am a licensed
There you
CPA,
go.
and I don't
I
do
knew
tax,
that.
and I don't do tax returns. I started my career in public accounting with Ernst & Young, and started my financial planning practice 17 years ago after leaving public accounting. But when I describe tax planning, the tax planning that we do for clients, I always actually bring up the CPA example, because people assume tax planning means working with their CPA to minimize their tax liability,
Right,
typically for the current year.
right.
And this is not a knock on CPAs, I am one. How do I minimize tax for 2026? That's going to be the laser tunnel focus for the CPA. We describe helping clients minimize their lifetime tax liability, which means once the CPA has done their job of getting you all the deductions and minimizing your taxes for the current year, how do we, as part of your financial team, minimize your tax from that point forward? So that's on the growth of your wealth, the distribution of your wealth, and ultimately the transfer of your wealth. There's 3 other points at which you can be taxed, not just the year you earned it.
Yes.
And that's really where our focus is on the tax planning side.
You know, it's funny, not funny, but I guess my father was born in Italy, so he was an immigrant here. I was the firstborn in our family. His retirement plan was property. He didn't have a 401k. He didn't believe in that. He bought 4 or 5 pieces of property, paid them all off, condos, houses, commercial property. That rent from that became his income, his retirement income, which was great because they also appreciate it. And because they were investment properties, he wrote off all sorts of stuff against them. There's good tax stuff with that, right? And he ended up leaving some of that to us. And it's funny how different states have different laws as far as what's exempt, what's not exempt, how much what's the limit that you can pay in inheritance tax and all that stuff. So you all deal with that as well. I mean, obviously, the transfer of wealth. Do you ever work with the kids of the clients that you have?
Yeah,
Absolutely.
Yeah, absolutely. Let me run back to the real estate
Sure,
piece that you
please.
said. Yeah, first off, a lot of our clients own real estate.
Absolutely.
Not just their homes. A lot of our clients own investment real estate. A lot don't. Real estate is a financial asset and a tool to build wealth like any other. It has advantages, disadvantages, and there are a lot of people who have made significant wealth in real estate. And there are a lot of people who have made significant wealth and never owned any investment real estate. So the key is just understanding how real estate can fit within a strategy. It can be a great part of a retirement income strategy. If it's all real estate, I had a client a few years ago out of state who had a lot of rental properties, and they had for their entire lives, and in their 70s decided that we're done with this. We're burnt out on
Really?
it, right?
Okay.
And so we had to completely change, or make very significant changes to how everything was set up. as they unwound all of these real estate positions that they had always thought were going to be their permanent income source for the rest of their lives. They just didn't want to deal with it anymore, right? So, it's a great tool. It offers some meaningful tax benefits and so forth. But like any financial vehicle, it has some very attractive components to it, and then there are some disadvantages to it as well.
For sure. Who wants to be a rent collector, So,
But on your question about the children, absolutely. Like, we talk to clients from day one about multi-generational planning, and how can you say you do comprehensive planning if it ends either at retirement, which we said is halftime, right? Or at death. So talking to clients about their purpose, their legacy, what that means to them, oftentimes it includes children and loved ones, right? And so we make efforts to meet their children, maybe not when they're 8 years old, but as they're getting a little bit older, we will try to bring them into the mix because we recognize that that is part of the financial plan.
Sure.
We want to serve families multi-generationally. And so to do that, including the children in that process at some point makes a lot of sense.
Yeah.
And by the way, Phil does meet some of them when they're 8 years old.
I
He
do.
actually-
Really?
One thing he doesn't talk about is that he goes into his kids' classes at Cornerstone.
Really?
And
that
does
was
a-
cool.
Do you give them
I
money?
did. It was a career day thing, and I went in there. I didn't think much of it. I borrowed this friend's Monopoly money gun,
Oh, cool.
and I ordered a bunch of fake $100 bills off Amazon, and I went into the classroom shooting $100 bills around the room. Fourth graders are clamoring over desks
bet,
on top
I
of each
bet.
other. And then I walked them through. I gave all of them 10 $100 bills. So I said, I got good news. You all get $1,000. They go nuts. Bad news is it's fake. It's fake money. But you do get to keep it. Yeah, okay. So, and they started with $1,000. Then I walked them through taxes. Does anybody know what taxes are? And then I said, all right, pass up
You started taking
$300.
money. I love it.
And then we talked about giving.
Yes.
Giving, charitable, being charitable,
Yes,
giving back.
yes.
Pass up $100, so
Yes.
10% giving. And then we did 20%
is
saving.
funny,
Does
yes.
anybody, want to someday retire or have things to save for us? We got to put some of this away for the future. So they pass it up. Then we talk about fixed expenses. They were left with $100, and I said, kids, make sure, because when you go to Quick Trip for the snack after school, or
Yes.
you go to Disney World this summer, thank your parents because that little bill that's left comes from that pile.
That's
not
funny.
that
That's
bigger
funny.
pile. So
That reminds me
that
of
was fun.
the Bill Cosby show, the scene where he teaches his son the same thing. His son wants to leave and go on his own. He's like, oh, Jolie, you're in high school. Dad, I could do that. You just give me some money. Even if I gave you money, he gives an example, perfect example. Pulled all that money away, poor little kid. He had like, what are you going to eat with, son? Nothing. Love that example.
Yeah.
That must have been terrific doing
No,
that.
it was so fun, and I'm actually
Yes.
talking to the headmaster of the school about trying to make it part of whether it's just 2 hours or whatever, but part of the curriculum for the middle school.
I think that's a great idea.
Just as a way to give back. I'm
Yeah.
passionate about it. And what do you hear
Yeah.
people at cocktail parties or
Yeah.
business events talking about that our education system needs to teach more of the real world stuff.
Not
Like,
just
kids
that.
don't know how to balance a checkbook.
It's the way
right?
you did it, though, because
Right.
it's very dramatic.
Tangible. I
Yes.
think it was tangible.
Yes, for
they
sure.
had it and then they didn't have
Yes,
it.
yes. Because if
So-
you do a calculated
Yeah.
thing, that's not real. But pulling those dollars. Yes.
Especially for fourth graders, they were freaking like, stop taking my money. So it was fun.
Even kids. I mean, my oldest just bought a townhouse. I think he's 6 months into it.
Okay.
I'm sure he's walking through the house shutting light switches off because the electric bill.
He's looking back saying, "Oh, this is why Dad did that."
He was doing that earlier when he lived on his own in an apartment with a friend. Yeah, so they do learn, but they should
Yeah.
learn it when they're younger. Middle school is a great time to learn that, I think.
Yeah, some of the fundamentals for sure. Yeah.
Did we're getting towards the end of our talk, our podcast. Did we forget anything? Anything you guys want to share at all? How can people get in touch with you all? That's the big part, right? Where can they go? What's your website address?
So you can go to www.4-corners, that's plural, -capital.com.
Right.
That's probably the best way.
Okay.
Yeah. You can also obviously call
Yeah.
or email us.
Call, email.
Yeah.
My direct line is 770-7710-606.
I like that.
770-246-8486.
There
Great.
But we're right here in Peachtree Corners,
Yep.
like you mentioned, on the Intuitive campus here.
Yeah.
So Triangle Parkway right here in the heart of Peachtree Corners, and we'd love to engage with as many members of the community as we can.
So we've been with Phil Adra and Victor Borowsky, great guys, family people that live in this community. Learned a lot from you all. I'm going to probably learn more after the show, maybe. But thank you. I appreciate
Thank you,
being
Rico.
with us.
Our pleasure.
Everyone else, if you have any questions, you know where to go. Leave your comments if you'd like. I'll have links in the show notes. If you're listening to this on Facebook, share it with your friends. On YouTube, leave a review. Also share it with your friends. That'd be great. And you could also catch this as an Audible, actually as Amazon and Apple Play and all that, Google Play. So follow us. There's more to come. Thank you all.